Focus is clearly on the credit markets or on what interest rates are doing. And what interest rates are doing is something different than what we're hearing from Chairman Powell and the Fed. And what the level of interest rates, whether we look at the 30-year or the 10-year, is saying that the federal funds rate has got to be reduced a number of times. And what I'm saying a number of times, I'm saying at least 4 times from current levels. Wow. That's down to 1.125. Now, you're not going to get 4 cuts in the federal funds rate unless economic conditions are really bad.
But Hugh,
and so what the message of the fixed income markets is things are going to get really bad, perhaps in the middle of 2020. Sorry, Kelly, go ahead.
Well, you bring up a really important point here when you say that the only way the Federal Reserve would cut rates that much is if economic conditions are really bad. Why does that have to be the messaging? They're waiting for the storm to arrive that way and then reacting to it instead of moving now. Couldn't they just say to everybody, look, there's not inflationary pressure across the economy. We raised rates too many times and we're undoing that. Why does the message have to only be about this is a slowing economy?
Kelly, what the Federal Reserve is doing is what they always do. And they're looking through the rearview mirror. Investors are not doing that. Investors are trying to look ahead. That's why you've got 2 different messages. And when you look through the rearview mirror, like Bob Pisani was talking about, some of the consumer discretionary, the numbers from retail are pretty good. You look at the economy, you look at employment, you name the variable. It's not bad, and it's hard to say something such as we're headed towards a real problem in the economy and we're going to reduce rates 2, 3, or 4 times. They're not going to say that. They're going to say they're going to imply, as they have, that they may reduce rates once. But investors are seeing something entirely different. They're looking ahead, and they say things are probably going to play out a lot more serious than the Federal Reserve currently is telling us.
Okay, Paul, same question to you. What's interesting to me about this idea that the 30-year yield is now less than the dividend yield is that the last time that happened was not 2006 or 2007. It was 2009. We were coming out of recession the last time this happened. It was not some sort of warning sign of anything back then. If anything, it was a sign of a major bull run in stocks.
Yeah, I'd be careful. We'd be careful about too many historical comparisons here, Kelly. We agree that the market is seeing something worse than what the Fed is seeing, but we would venture to offer that what the Fed is seeing, or what the markets rather are seeing, is that the global conditions are getting worse, not so much that the U.S. conditions are getting worse, and that those conditions will continue to deteriorate. And in light of that expected deterioration, the Fed is still too tight. Even if they take out that final rate hike from late 2018, the dollar is still too strong. That's a sign that dollar liquidity is still too tight. They're going to have to cut more than once.
Let me translate this as well to what you guys think investors should do here. Paul, you like utilities and real estate. Why do you like them at these levels? They're quite high. They're the best performing parts of the market.
Yeah, we went back to neutral from being unfavorable because we think that yields probably have further to fall, and that's going to dominate the more negative fundamental conditions for those 2 sectors. What we really like here is information technology. We like consumer discretionary. We also like financials.